Fed Chairman Jay Powell says getting inflation under control won't be easy, and there will be some economic pain. He made those comments during an interview yesterday with Marketplace. Let's get to Steve Leisman now, who is taking a look at just how high rates could go. Hey, Steve.
Morning, Joe. Yeah, whether there's a soft landing or not, as Fed Chair Jay Powell said, is possible but not assured. It's going to depend on how high the Fed raises rates and how fast it does so. But neither Powell nor any other Fed official has explained with any precision just how far the Fed will go. And there's speculation it could go further than the market has currently priced. Take a look at where it's priced now. The market currently sees the Fed ending the year at 2.7% on the funds rate, hitting a terminal rate in this cycle of 3% in August of 2023. But maybe it could go higher. Here are some reasons why. The need for the Fed to adopt a restrictive policy to combat inflation, an upward shift in the long-run inflation and long-run neutral rate, a wage price spiral, and more importantly, an end to factors that have kept inflation in check: globalization, immigration, excess savings, and technological progress. Annetta Markowska of Jefferies, she sees wages continue to drive inflation and writes, the Fed funds rate will probably have to rise north of 4% in order to break inflation's back. However, recent evidence from unit labor costs to JOLTS and ISM reports suggests the floor may be shifting higher. How much higher? If you factor in a positive funds rate, that is, one where the inflation-adjusted rate is above zero, 5% not out of the question. Here's how you might get there. Factor in first 1% a long-term average real Fed funds rate, a 3% underlying inflation rate, and the Fed could potentially lop another 1% on top of that to slow the economy down, making it restrictive. Before the great financial crisis and its artificially low rates of the past 14 years, the nominal funds rate was 5% or higher more than half the time and 4% or higher 2/3 of the time. The real funds rate was almost always positive compared to the long-running negative real rates we've had in most of the post-great financial crisis world. And if we're going back to a world of a positive funds rate and one of higher inflation, it's going to present a dramatic challenge to the risk assets across the spectrum. Joe?